first I'd like to say a warm and happy New Year's to everyone. Hopefully it's happy and prosperous and, of course, healthy while looking into 2019. It is a Chinese New Year of the pig, which is actually supposed to bring fortune and good luck. I think we all need some of that. It's a great year to make money, apparently, and to invest. But right now, of course, we're going through a little bit of a pain trade right now. Overnight, you saw Apple kind of downgrading their top line guidance, ISM data looking for slowing growth. You know, the trade wars are ongoing, you have geopolitical tension. Of course, locally, we have a slowing housing market, and of course, we have the federal election looming as well. So 2019 obviously looks like it's going to be another volatile year, I would say. So essentially for us on the healthcare side, it's really a stock picker's market. And I would say capital preservation and asset allocation is going to be paramount this year. And we can see a chart that Scotty and I have put up in front of you that says, you know, the healthcare index, you know, even though the broader market has been falling away, healthcare has been performing quite admirably, up to 7 of the last 10 years. In the last year, it's up over 20 points, outperforming of the broader market. And that's actually leading to its gains over the past 5 years. It's up 155%, outperformance, by the way. And over the 10-year period, it's up a massive 183% over that period. So it looks pretty good, a good place to be. So I believe that, you know, healthcare, the perceived safe haven industry, which it is a low beta names and the large caps, is a nice place to park some cash for a while and look for good quality names across the space. And we believe it'll be a top sector pick going into this new year. Now, turning quickly to the GP clinics and pathology center owner Helios. Now, this is the rebadged primary healthcare. The ticker here is HLS, if people don't know it, because it is fairly new. So they said a rebadge and primary. Really looking to add to the growing list of consolidation that we're seeing happening across the healthcare space. That is really adding to the bid or the attraction of the sector. You know, it's adding to the Healthscopes of the world and their bid, and of course API and Sigma and their merger as well. So we did have a unsolicited takeover offer given by Chinese-based Zhongho to acquire, all the shares, outstanding shares of Helios that it does not own. It currently owns 16% of the register, so it's looking to pick up the 84 remaining shares via a scheme of arrangement priced at $3.25. That's about a 33% uplift to the last close of the stock the other day, and valuing the company at 2.1 or 2.0 billion dollars. The offer, however, is highly contingent. As in the note we published last night, nothing too unusual or onerous. We think in the contingencies, you know, the obligatory due diligence process, they say will take about 5 weeks. We need the board approvals, of course, of both companies. Regulatory clearances, and of course we need no material changes, and of course debt financing to get this across the line. The board currently said that it's currently assessing the offer and will make a determination as to its merits in due course. So the bid actually came of a bit of surprise. I mean, obviously Zhongho has been sitting or has sat on the register idly for 2.5 years. It's kind of interesting that it puts forth a bid at the I would say the quietest time of the year here locally, outside of the festive season. And when Helios, you know, does come out, it's pushing through. Helios is pushing through a once-in-a-generation change of its business model as well. So it's an interesting time for Zhongho to move the needle there. Helios is repositioning all of its key verticals across all of its major investments. It's been the worst performing large cap healthcare stock, down 30% year over year. And it's been trading at multiples that are at year lows. So call it opportunistic or call it actually antagonistic, or I say hostile. Call it what you may, but it's interesting how they put the bid in. It values the company at 7.1 times EV to EBITDA. Now that's quite a distance below Primary's historic trading range, which is about 8 to 10 times, and about 40% below Sonic's current trading range, which is 11.3 times. So as I said, it smells opportunistic, but I would call it almost hostile or antagonistic. Regardless, I guess the key message is here today, what do clients do? Should we be buying this name? Obviously, the shares closed yesterday. It's quite volatile. They closed at 263. Still represents considerable upside to the 325 price takeout target. That's about takeout. That's 24% upside. But we do see numerous risks to getting this transaction up. I think regulatory sign-off is not necessarily a given. They do hold a big place as far as the healthcare space, because they're not a critical infrastructure to this country. However, They do run the second largest medical center business and pathology business and digital imaging across this country. And I think the sovereignty risk with data and healthcare is going to be an issue, especially going into an election year. We do see potential for earnings downgrades, so material changes, of course, to this business model, because they are facing a slowing industry, and they flagged that in their AGM, saying the second half is going to be stronger and requires actually the reversion to mean of the growth rates in this second half, and we haven't seen it yet. So we see more earnings downgrades perhaps, and we have disruptions potentially to their physician model. Now, what drives Helios is really the physician on-take, or they run medical centers, as I said. They need to hire physicians to drive that model. Now, physicians nowadays, it's pretty lumpy as far as the churn rate historically for Helios. They actually improved in the last couple of months, the last quarters, but now with the Chinese bidder potentially as your potential suitor, what's the feeling out there that they're going to have a would-be Chinese owner? That's going to be interesting to play out and see how that works in recruitment. And of course, as I said, it looks like a very low ball offer. So I think the board would outright reject this bid. So what do you do? Sorry, in light of this all, I would say investors keep powder dry here. I think this one's too hard. Let's see how it unfolds. I'm waiting on the sidelines for this and see who address it when we see what comes back from the due diligence process in the board. What we really like in the GP clinics and pathology space is Sonic Healthcare, this ad-rated ticker as CHL. It really defensive earnings coming from this company. It's unlike Helios. It is more ex-Oz exposed, really growing its footprint. Obviously, they had a recent transformative $275 million acquisition of a U.S. asset. It's a market leader in 8 different countries around the globe. It has a very strong balance sheet, over $500 million in capacity for further acquisitions. It's trading at 16.5 times forward earnings. That's roughly in line with its long-term 16.5 forward historical range, and it yields about 4.5% on a divvy. So it looks pretty good for us. And I remind you that our clients surely should get into the $100 million SPP that's going on right now. It opened for shareholders on December 11th, so it'd be registered by that date. It closes on the 4th of February. Shareholders can purchase, remind you, up to $15,000 worth of shares. So, and no more than $19.50, which was the offer price. So I think, at today's dollars, it's $1,600 laying on the ground. That's money for Jam. I'm picking it up all day long. Would definitely advise your clients to put all in $15,000 into that name. I really do like it. And with that, I think I'll pass up to Scotty to talk about the aged care sector. Scott still looks like more of a pain trade of late, and as well, I think you're going to run through some catalyst-driven names that should be much better in this type of market right now. Scott?
Yeah, thanks, Derek. Yeah, so just on that consolidation theme, I think we're going to see a fair bit more consolidation across the healthcare space. I'm going to throw aged care into that mix. Everything's going wrong at the moment. We've got a Royal Commission. We're going to see higher costs coming through from compliance, from greater staff nurse ratios. Share prices are bouncing along their all-time lows. We saw Japara just before Christmas come in with a downgrade where they're basically saying their earnings will be in line with last year, and that was lower than what the previous guidance was of a 5 to 10% growth. However, saying all that, it does feel like the share prices and these companies have found a bit of a base. Wouldn't be surprised if there is some opportunistic consolidation activity across aged care. But we're keeping a hold rating. Similar reasons for what Derek was saying with primary healthcare. It's just it's a difficult place to be at the moment, but just flagging that potentially some consolidation activity might come through. Derek did mention the possible merger between API and Sigma. We're going to keep a close eye on that. Putting those two companies together does make a lot of sense. It's a mature industry, pharmaceutical wholesaling. Margins are very tight. However, if we do put those two companies together, we can see some good earnings growth coming through. That's got about 6 months to play out. The key risk there is getting ACCC approval through. So we'll be watching that one closely for you. Just moving to some more catalyst-based names in this volatile market, it's probably a little easier to look at some really short-term opportunities. Two I'm just going to highlight today. One of our favourites is Volpara. Digital healthcare company uses artificial intelligence to aid the early detection of breast cancer. We're coming into their 2 strongest quarters. So late January, we're going to see them report their December quarter. They have a March year end. We expect that March quarter to be very strong. They're gaining customers all around the world, particularly in the US. They provided guidance of 9% of women in the US to be screened using their technology. We expect that to be reconfirmed when they report in January. So Volpara, one of our key picks, some short-term catalysts coming. The other company I'll just draw to your attention is ResApp. Again, this is another digital healthcare company which diagnoses respiratory conditions using the smartphone. We put a note out in the pack today for you. Two key catalysts coming up in the next month or so. One is the Croup results out of their pediatric trial in the US. They're due to report shortly. And also there's a major study in adults that was conducted in Australia that will report shortly as well. We've actually got the CEO of ResApp in the morning meeting on Monday, Tony Keating. So it's worth having a look at with some key catalysts coming up.